I just wanted to give investors a bit of an outlook in relation to what we're thinking about for the year 2014. Certainly in 2013 there were a number of different factors that basically drove markets higher. And if you're invested in these asset classes, you've had some great returns come through, and we are certainly one of those. But in essence, what we need to really decide is whether or not this market strength can continue into 2014. Undoubtedly, the economy has moved away from recession type levels, from a lot of scare and a lot of sort of systematic risks that we've seen over the course of the last 5 years, particularly since the GFC. Those risks very much have sort of played their way out. But we're still in an environment where markets have rallied substantially. The S&P 500 has essentially reached about 170% above its low that it reached in March of 2009. Is it justified? Is the economy that strong that it's been able to sort of generate that degree of economic activity which is fed into earnings coming through? It hasn't. You know, the US economy has had the slowest recovery it's possibly had. And when you're looking at Europe and Japan at the moment, the individual sort of regional problems that those two regions are going through is unsubstantiated. It's unprecedented. So we're in a situation where there's still a lot of risks that we need to work through. Nevertheless, markets have really accelerated, not to the tune that they've been able to sort of justify an economic recovery, but to the tune that substantial costs have been removed from a lot of companies. And that's what's been driving earnings. Not sales, not necessarily a whole lot of price increases that they've been able to put through the market. It's all cost cutting. So when we look at market valuations at the moment and we actually try to anticipate, are the earnings going to continue the same way that they have? You can't do that unless you continue to cut costs and take costs out of the system. And companies are running very lean at the moment. So what does this mean for our portfolio, and what does it mean for our particular positioning? The S&P 500 in the US has essentially reached all-time highs. The economy has not justified those particular levels. So we now are in a position where we think we are going to take risk and have taken risk off the table in our portfolios, because we see the potential for either a correction or just for the markets to stay flat as being the highest probability outcome for the next 12 months. Now that said, taking risk off the table means that we sort of forego any potential opportunity that the markets may still present to themselves. Markets tend to get overdone at these sorts of situations, and there can be a situation that could lead to further market gains over the course of the 12 months, but we see that as a very low probability. So we are managing the portfolio in accordance to where we are, taking risk off the table when markets are at the top end, putting risk back onto the table as we did in 2009 when markets were too pessimistic about what the outcome was going to show. So that's the way that we will actually take our approach to portfolio positioning. Very contrarian in that sort of nature, understanding the risks that are out there and really being able to manage the portfolio accordingly, putting strategies that actually manage the downside risk as opposed to just taking risk off the table. That's a big difference in our portfolio, particularly when I sort of consider it against some of our peers.